So let's bring in Peter Schiff, who is actually predicting the dollar's demise, Peter, of course, of Euro-Pacific Capital here. He joins us now. Peter, what's going to actually precipitate this? Because so far, you know, the dollar has proven to be a safe haven currency, and so we have not seen a collapse, nor have we seen the beginning of one.
I don't think there's much safety in the dollar. I think, the dollar moved up a little bit today on the back of higher interest rates. But, it's not. The Fed isn't getting aggressive in raising short rates. It's just the longer end that's really moving up. And that's not because the economy is improving. I think that's because the bond vigilantes are coming out of their coma. They realize the Fed is out of ammunition here. All they do is they try to goose the economy artificially with cheap money. They brought interest rates down to zero. They couldn't do anything else, so they tried quantitative easing to try to get the long rates to go down. Instead, they shot up instead. So it's a complete failure. Interest rates are headed a lot higher, and all we're going to do is keep borrowing and printing money. That's not good for bonds, and it's not good for the dollar. This little dollar rally will not last, but I think the bear market in bonds could finally be here, and there could be a lot more legs to it.
Hey, Peter, it's Brian Kelly. During the Depression, the countries that did not expand their money supply actually didn't recover as fast as the countries that did. That's exactly what this Fed is doing. So it's similar to a stock or a company issuing stock to buy growth. That's what we've done here, and that's what the market's signaling. So if we get that growth, then the dollar should appreciate, particularly if rates are going up.
Maybe it's like a penny stock issuing shares to dilute everybody. You're not going to get economic growth by printing money.
But we
get economic growth.
We are getting economic growth right now.
No, we're not seeing any growth. Where are you seeing it?
What about retail sales? Look at Home Depot.
How about this?
Retail you tell me where we're not seeing it.
Spending money is not economic growth. We're borrowing money and buying products.
How is spending money not economic growth?
Peter, the fact that we're spending...
What is economic growth?
Hold on, guys.
Economic
we're all talking over each other. We can't hear anyone. Tim asked a question.
Economic growth is capital investment. It's production of goods, not the consumption of goods. Going into debt to buy more products that were made in China, maybe it shows the Chinese economy is growing, but not ours.
Nobody's going to produce goods if there's nobody consuming
I'm going to blow the whistle here. Okay, guys, Tim asked a question. Tim was going to ask a question, and then Peter's going to respond.
There's a lot of people who like to hear themselves talk out there. The bottom line is, Peter, first of all, where are the Chinese going to go? You're talking about rates are backing up here. Where aren't they going up? You show me a country around the world where rates aren't going up. You want to be in Europe? And you tell me what happens when the 10-year goes over 4%. The Chinese will be first in line to buy the 10-year. You tell me.
No, they won't.
Where are rates going to go, Peter? Are rates really going to go up to 6% next year? In this world, in this environment, where are you going to buy it's a better deal than Treasuries at 4%?
Treasuries are a lousy deal. I think rates
what
are going to go.
What are you buying then? You've always got a lot to say against the dollar and the U.S. government. What are you buying that's not gold? And give me something specific.
Well, I am buying gold, but I'm buying stocks all around the world. I'm buying commodities. If interest rates are going to go up, but the country that's going to be hurt the most by higher rates is the U.S. because we have the most debt.
The U.S. has the most ability to issue debt. The U.S. is the largest bond market by a factor of 10.
That's
the problem. You think people are going to run away from the table just because yields have backed up 5%? This is actually a buying opportunity.
But with whose money? Don't buy with
money.
You want to buy
the Chinese
with your money,
have done better
ahead.
than anybody in this bond market. The people that you say are going to run for the door are the people that have made the most money and have the most to lose.
We've been in a bull market in bonds for 20 years. You think that's going to go on forever?
All right, Peter, I'm going to insert myself into this conversation because I want to actually get to the bottom line here. You said you're investing in stocks around the world. Can you give us a name of stock that's going to yield more than, say, a 10-year?
Just about every stock that I buy that's not a mining stock yields more than a 10-year Treasury.
Give us some names, Peter, because we want to be constructive in this conversation.
Well, I don't have to give you names. I can give you ideas and themes. You want to try to stay invested in companies that are exposed to the growth that's taking place outside the United States. You want to look at the new emerging consumers, the people who have been saving their money and producing. Those are the consumers of the future. Americans are the consumers of the past. We're broke. Right? So you have to have businesses that are going to benefit from this change in global wealth as the world moves away from a U.S.-centric model towards other nations. So I'm focusing on Asia, where people are working hard, where they're producing, where they're saving. I'm focusing on countries that have a lot of natural resources that they're able to export to take advantage of the strength in those markets. And I'm avoiding anything that has to do with the American consumer. Either they're spending money or they're having to pay back the money that they borrowed. We have a lot of problems that we have yet to confront in this economy. The real U.S. collapse wasn't in 2008. It might happen in 2011 or 2012.
Peter, we're going to continue this conversation a little bit later on in the show. We're running a little bit behind here. Peter Schiff, well, We just had him on, and he was quite a firecracker, so we thought we brought him back on. He's actually been a YouTube sensation by calling for the collapse in the housing market way back in 2006. Of course, a very good call. His next call, as you heard before, that a dollar collapse is imminent, and as promised, he returns now for his top trades of 2011 off of that event. All right, Peter, 3 trades. Walk us through. Number 1.
Well, first of all, it's not just a dollar collapse, it's a bond collapse. So you want to avoid any kind of long-term bonds, treasuries, municipal bonds. You know, the Fed threw everything but the kitchen sink at the bond market, trying to get rates to go lower. They're going higher instead. I think the bull market in bonds is over, and the mother of all bear markets has begun. So stay away from bonds. The Fed's going to print a lot of money to try to slow down the rise of interest rates. That's going to be terrible for the dollar. So you want to own the precious metals. I think the gold bull market is going to kick into a higher gear. So stay with gold, stay with silver. And, you know, there is a lot of economic growth. You know, earlier we talked about all the goods that Americans are buying. Well, there actually is economic growth in the countries that are producing those goods, that have invested, that have saved, that have the capital and the factories. So you want to invest around the world where there is legitimate economic growth based on savings and underconsumption and capital investment. So, you know, you can get a lot of value and you stay out of the dollar, because when you're investing abroad, not only do you get the growth of those stocks, but you get protection, because if you own foreign stocks with foreign earnings, as the dollar goes down, you get that protection.
All right, Peter, thanks for your top 3 trades of 2011. Peter Schiff of Euro Pacific Capital.